Hi, I'm Ben and welcome to Motivation to Invest. Our mission is to motivate you to invest for your financial freedom. Whether that means escaping the 9-to-5 drudgery or just improving your quality of life, I'm here to help you by providing you with valuable investing tips and strategies. The recent global issue has caused a massive number of travel restrictions to be implemented and lockdown of the entire planet. Thus, this has caused a global drop in oil demand and subsequently share prices have plummeted. So is now the greatest time to be investing in oil stocks, or is the future of the oil industry over? Are there some oil companies which you should avoid, which seem like bargains right now, but could be a recipe for disaster? So in this video, I'm going to explore these questions and also tell you how I made £1,000 in just 7 days investing in a few great oil companies. Let's dive in. Over the next 25 years, the world will need an additional 25 million barrels per day of oil. To put things in a different perspective, that's the combined US and Saudi Arabia worth of new oil production at a demand growth of 1 to 2% per year. In the short term, the number of oil rigs and shale operations in the USA and Canada have increased massively. Thus, this excess increase in supply and a temporary drop in demand due to the global issue has caused oil prices to plummet. Thus, the risk for investing in oil include increase in supply, oil production costs, for example, shale oil and smaller producers may have higher operating costs, disruptive technology such as electric vehicle technology, renewable energy. This is an area where I'd suggest you need to be conscious of in the next 10 to 15 years and how it will affect oil prices. This industry is currently growing at 20 to 30% per year, and renewable energy accounts for greater than 50% of power supply post 2035. There is also the consensus, which is gradually turning against oil and fossil fuels. You notice this on many oil companies' advertising, in which they show solar panels as opposed to oil fields, when the majority of their revenue comes from these oil fields. You also have more recycling and less new plastics are required. Thus, to mitigate these risks and still get good returns on our investment, we need to make sure that we invest in oil stocks using the Warren Buffett method. That is, having a margin of safety when you invest. So you're finding great companies at below market value deals. Now, this latest crash could definitely be one of those times. Also, you should look for companies which have a large exposure to the gas industry, as gas is the only fossil fuel which grows its total energy demand until 2035. Thus, looking for companies with large exposure to gas production is extremely useful and will guarantee you great returns on your investment. All large and small oil producers are investing lots into oil production. These number of investments in production will create an excessive amount of supply, in addition to all the new technologies which could potentially disrupt the industry. Thus, due to the only 1 to 2% increase in global demand, it is essential that you purchase these oil stocks at below market value. For example, ExxonMobil is still very profitable at $40 a barrel, and thus continues investment into oil production. However, at just $25 a barrel, many oil production projects, especially the shale projects, will just break even or even lose money. But it's clear that larger oil companies are preparing for lower oil barrel prices. Now, the latest market crash and thus international travel restrictions has caused a global drop in oil demand. This, combined with a very, very heavy supply, has created a recipe for disaster. An emergency OPEC meeting had to be called. OPEC is the oil producing and exporting countries. They met up in Vienna to discuss how they should stabilise oil prices by reducing the production and not going into a price war. The idea was to get all countries to agree on a price floor. So each country can decrease its production by 5%, but the price may increase by 15%. Thus, the country actually ends up being more profitable. Demand is currently at 100 million barrels of oil per day. Supply is currently 1 to 23 million barrels of oil greater. However, Russia originally said they are not agreeing to this price floor, and Saudi Arabia wished to even increase its production to 10 million barrels per day. Now, Saudi Arabia has a very low production costs and thus is still profitable even when oil prices are low. Their return on average capital employed is 41%, and Saudi Aramco's margins are 30% of their net income, while a company such as Shell is happy to get 5%. The good news is Saudi Arabia and Russia finally agreed to cut oil production costs after international pressure was put upon them. Currently, it's just $22 a barrel, down from its previous high of $60 a barrel. OPEC is trying to keep the price floor at around $40 a barrel. This price swing has been further enhanced by the US oil and gas production going from 8 million barrels to 15 million barrels per day. Now, back in 2010, the US oil industry learned how to start drilling horizontally and thus implement fracking and other operations. This allowed the US to double production over the past 10 years. When oil prices hit $80 a barrel, every man and his dog wanted to start an oil company. The vast number of these new oil companies took on a large amount of debt in order to increase production rapidly and take advantage of the $80 a barrel prices. So what does all this mean for investors like you? Well, you should steer clear of companies with large amounts of debt. Be sure to check out the company's asset to debt ratio. As with many smaller companies, when the oil prices are so low, their margins will be destroyed and they just won't make any money. Many people have been burned recently by investing into these risky startup companies which are massively over leveraged, as their calculations assumed that oil prices would forever be at $80 a barrel or potentially only drop to $60, $50 a barrel. They are not ready for the $20 to $30 a barrel territory. Instead, I would suggest investing into large companies, those with sound fundamentals, steady cash flow, and capital discipline. You should also look for companies which are investing only in the highest margin barrels. Thus, they can ensure they're going to make significant profits even if the oil prices plummet. Companies such as Shell, BP, and Exxon are some of my favourites. These companies are mammoths of the oil industry and thus have excess cash to acquire these smaller oil companies which are going bust during this latest stock market crash. BP, Shell, and Exxon will also be selling off any bad assets and inefficient operations to thus reinvest that money into more efficient oil production operations. On this channel, we don't give specific financial advice, so always do your own research before investing into any of these companies. These are just my suggestions after doing quite a bit of research into them. Now, to protect yourself from the risks mentioned previously, such as electric vehicle disruption, drop in oil demand, increased supply, you really need to look for companies where you've got a large margin of safety. So when the market sentiment of the oil industry is very, very bad, you can ensure the stock market prices will be very, very low. That is the time you jump on and invest. This is a low risk, high reward strategy of investing, popularized by the great Warren Buffett. Now, there will be a lot of bargains during this latest oil crash. There'll be a lot of these smaller oil companies which will be so cheap, which you may be tempted to purchase. However, I would urge you to steer clear of them. Due to the debt issues mentioned previously, many of these will go bankrupt. Now, as Warren Buffett says, it's better to purchase a good company at a fair price than a fair company at a good price. Remember those words of wisdom when you're doing your investing. To show you an example of my previous investments, I invested in two of the largest oil giants in the world. I invested in Royal Dutch Shell and BP when they were at rock bottom prices. I saw a 70% ROI in just 7 days and made £1,000 profit off a very, very small investment. Now, as a long-term investor, the £1,000 profit doesn't really make a difference to me. However, it's still nice to watch your investment grow in such a short space of time. This gives us indication of a potential V-shaped recovery from this latest stock market crash. So I hope you enjoyed this video and it gave you some valuable insight into the oil industry and into oil stocks as a whole. Now, it must be said that Warren Buffett tends to avoid oil stocks, as the cyclical nature can be very volatile for him. However, I would suggest a small exposure can offer great returns and enhance your stock portfolio. But always remember, diversify, diversify, diversify. Putting all your capital into oil stocks is very, very risky, as it's such a volatile industry. I would love to know your thoughts on this video, so please do comment below. And if you enjoyed this video, go ahead, smash that like button and definitely subscribe. See you next time.